Hi, I'm Edward Cohen. Welcome to Tangent. Today on Tangent, we have Ben Miller, co-founder and CEO at Fundrise, America's largest direct-to-consumer private markets manager, including real estate, venture capital, and private credit. Hi, Ben. Where does this podcast find you?
In Washington, D.C.
Beautiful. Capital of the empire. Let's jump into it. Fundrise. So for almost 100 years, government regulation has made it virtually impossible for individuals to invest and access private markets. Now, Fundrise is disrupting the status quo by empowering now over 2 million users to invest in high-end private market assets. Ben, you've been at it since 2012, but you didn't start with your current model. Would love to learn how you arrived at the current model that's enabling so many individuals to become investors.
Yeah, I feel like anybody who's ever started a company and scaled it learns that a lot of the things you think are true end up not being true, and you have to follow the customer. And so we began the business by launching real estate deals, basically democratizing investing into single real estate deals. And we did that because I was primarily a real estate person, and that's how real estate people think. And so I built a model around my preconceived notions, and probably most real estate people's preconceived notions. And over the course of a few years, I discovered that most people are not real estate professionals. By far, the majority of people are not real estate professionals, and even real estate professionals maybe aren't that good at real estate investing. I mean, everybody's got opinions, but when it comes down to it, it's there's a lot of bias in the process. So we moved the product to become funds, real estate funds, tech funds, credit funds. The fund might be a strategy like build for rent or industrial, or it might be a sort of all diversified fund. But over time, essentially, we modeled ourselves on Blackstone or private equity model, which is, if you look at the biggest real estate investors in the world, they don't do deal by deal investing, they do funds. And we got there for this very similar reasons. You can have a professional institutional investor like California Pension Fund, CalPERS, or New York State teachers. They manage $100 billion, and they would rather invest in a fund than a deal.
More diversified.
Well, you're basically ultimately paying someone to do the work.
Mm-hmm.
And one of the misconceptions of real estate is that the investment is the most important part, when actually the operations are just as important. And if you're not operating the asset, you're just investing in it, you're missing half of the analysis. And so the idea that you're picky, choosy, deal by deal investment, I think we're seeing that start to fall apart in this environment where there's capital calls, there's a lot of operating issues in every property. And because they're not a fund, they're deal by deal, the manager is handicapped with his ability to make good decisions and recapitalize deals or refinance them in ways that make it through this downturn. So it's basically like, if you look at most internet companies are actually an online version of an old line company. Like Amazon is a similar online version to Walmart
or Sears.
Yeah, I think Walmart. But anyways, and so we're an online version of Blackstone. We had 150 copycats, and when they said, "Well, we're going to be a marketplace," I go, "Well, what's an old line version of a real estate marketplace?" I don't even know.
No such a thing.
Yeah,
no such a thing.
Not a thing.
It's not a thing.
Maybe a brokerage firm. So I said, okay, well, I'd rather be Blackstone than a broker.
So this is fascinating. This has basically enabled you to have more visibility, more control, and further, not guarantee the best returns always, but definitely be ahead of the curve, be delivering better results than public REITs for investors, correct?
Yeah, I mean, I think that we have and we can deliver better results than normally accessible to individual investors. So the most common comparison we have is Vanguard REIT Index. The Vanguard REIT Index versus our portfolio, we've outperformed it by a lot, by thousands of basis points. And that's because the Vanguard REIT Index has two or three weaknesses that have manifested acutely in the last few years, which is that it has all real estate. It's an index of pretty much all real estate, and half the real estate or a lot of the real estate is very bad today, right? So office, you wouldn't want to index the office market, just like you wouldn't have wanted to index the mall market. It's like it's a collapsing market. So by having an index of all real estate, essentially you're getting the good and the bad. And the second thing is that there's an arbitrage opportunity between public and private markets. Sometimes public markets are better priced. Sometimes private markets are better priced. You want to go where the pricing is better. You don't want to be constrained by public or private. And our funds can do both and have done both.
Huh. Interesting.
And because it's ultimately like one of the things I learned about finance is that the reason why managers perform badly or well is often nothing to do with the manager and much to do with the structure of their fund. And so if you can only invest in office, right? A lot of times when you raise a fund from institutions, you can only do one thing. They're hiring you to do a job. That job might be invest in industrial or invest in public REITs. And whether or not that's a good thing to do 2 years later doesn't matter because that's the job they hired you to do, and that's the only thing you can do.
All about the incentives. If you're incentivized to deploy a fund in an asset class or in a region, then that's what you're going to do, regardless if the data suggests that that's riskier than what you could be doing, even within the real estate space.
That's true, but I mean, I would just I'll be more generous that like you were hired to do a job. Like if I hired my janitor to clean my floors and they go off and start to paint the house, I'd say, what the hell are you doing?
Fair.
It's not your job. I didn't hire you to do that.
Right. Fair. But if the janitor sees the backyard that is also dirty and cleans it up as well, maybe you'd be appreciated. I don't know.
Yeah, maybe. Or maybe they ripped up like the flowers, not realizing those were like not weeds.
Hey, what are you doing back there?
Yeah, you're not a professional in that thing, landscaper. So that's what I mean by structure is that what's happened since, take 2019. 2019 and 2020 had a massive change in the market. We had a pandemic. 2020, 2021, you had a massive change in the market, return to work, inflation. 21 and 22, you had basically then a change in interest rate environment and everything changed. And so over the course of 3 to 4 years, massive changes over and over again. Any job you were hired to do, it become obsolete within 12 months. But the structure of the financial industry prevents you from being flexible.
Right.
And that's what I mean by the advantage we have is we have more flexibility.
That's a very good point.
If you look in mid 2021, like June, let's say, when everything was go, if you had gone 100% to cash and held cash for 2 years, you would have outperformed every other asset class. Cash. Name a manager who can be 100% in cash for 2 years when cash was generating zero all of 2021 and most of 2022.
I mean, it would just require an inhuman level of discipline and lack of FOMO and, many other things.
It would require a lot of the manager, but I would think the LP would sue you. You weren't hired to do that job.
You weren't hired to get me the highest possible returns. You were hired to work.
You were hired to do work. Yeah.
Yeah. Interesting. Let's talk about the Fundrise platform. So it is, I find it fascinating that it's end-to-end, correct, for the investor?
Yes. Over the last 10 years, we have been like a caterpillar. We've sort of chewed our way from one end of the value chain to the other. So from the investor all the way to the property and maybe even all the way to the tenants.
Well, so what does that mean? What are the key components that improve the experience and the returns overall? Yeah,
it's one of those things that like is invisible to most people in the same way that I go to the grocery store and I don't know where that orange came from and how it got to my or even at a restaurant, right? It's more like a restaurant actually when you're an investor. You don't know, how many people were involved in picking that orange and creating it, putting it on a train, sending it to a ship, and then the ship had to get to, harbor. They had to uncrate it and then, put it to a logistics warehouse, and then the warehouse had to then send it to the store, and the store had to, and there were buyers, and there were like all sorts of quality controls around it. That's actually how the investment industry works too. It's just it's instead of an orange, it's a dollar. Your dollar moves through a supply chain, but you don't see that happen. So in the traditional world, right, you are an investor. I just got to do one version of the supply chain. You're an investor. You put your money into a pension fund, right, a defined benefits pension fund or a defined contribution. That pension fund manager then, right, that's sort of like a first stop in the supply chain. They take that money, they aggregate it with lots of other oranges, lots of other dollars, and they may give it to a private equity fund manager after they basically selected they've gone through and reviewed a bunch. They give it to private equity fund manager. That pension fund has charged you some amount of money for that, fees and operating expenses for the first step in the process. The private fund equity manager is charging you 2 and 20, and they're basically out there looking for mostly sponsors, right? So they're looking for a real estate partner who's got a certain kind of real estate deal, and they're going to give the money to the sponsor. And the sponsor basically is going to, maybe they give the money to a multifamily developer. They're going to build a part of a building. Okay, so there's a third person in the chain, and all three of them have taken fees, and all three of them have carried interest, and all three of them have operating expenses that they've charged to that money. And then they got to send the money. Maybe the building gets built, maybe the building gets sold, and they got to send the money back to the supply chain. And along the way, there are brokers who took fees on buying the asset. There are brokers who took fees on selling the asset. There are financing fees and capital market brokers who were involved in the financing, all up and down from like just maybe in the raising of the money in the first place. There was a capital market like fundraiser. So you just have the supply chain where what's happening is behind the scenes, 50% of your return is disappearing through the cost of the supply chain.
A lot of more extraction than value creation.
I mean, I could argue that there is value creation. I'm not making a value judgment. I'm just saying this is how it works.
Right. But now technology has enabled us to streamline essentially a lot of these components.
Over time, technology will move that dollar much more efficiently.
Right.
And you can see the parallel because it happened in public markets. If you go back 50 years ago, public markets had brokers and they had commissions and they had the market makers would charge fees and there were the trading floor had thousands or hundreds of people on it, and now it's all become driven by software, right? You can go online, put your money with a online zero fee broker. That money can move to the markets. It's all done by machines, all super efficient. And over time, essentially, it's very, very hard to beat that index.
Right.
The index basically outperforms because it's super efficient, and it's hard to add more value against a super efficient machine. And so that's what's happening in private markets. It's happening little by little, but over time, especially with the advent of AI, it's going to become machine-driven, efficient, super low cost. It's going to it probably takes another 10, maybe even 15 years, but you're going to end up a place where it's almost like the public markets and efficiency.
We're going to talk about AI in just a second, but your most recent banger has been your innovation fund, which allows investors to participate in tech startup investing even before their IPO. The fund includes companies like Canva, Databricks, ServiceTitan, Roblox, ZoomInfo, as well as some public ones too. So what's the big opportunity in democratizing VC venture capital investing, and why are you doing it?
Well, so for real estate, we built a technology backbone that is end to end, that is slowly but surely kind of wringing the costs out, and that supply chain can be replaced with software. And that also, when you bring technology to bear, what happens is you lower the cost, and actually as you lower the cost, you increase access. Right? Not everybody could afford a car, but when the cars get less expensive, then everybody can buy one. So part of what's happening with our democratizing investment is that it's actually about making it so efficient that anybody can do it. And that supply chain transformation is true for not just real estate, private equity. It's also true for, private credit or venture funds, right? It's the same supply chain, just different asset classes. And if you were to say, what are the best investment classes in the world outside the public markets, I believe it's real estate and venture capital. And so then you say, well, how do I democratize investing in venture capital? We've already democratized investing in real estate. And that took some regulatory work, right? We had to basically work with the SEC, figure out a model because no one ever done it before. And then we had to get access to the best companies, which, like when I launched the real estate part of our business, everybody told me it's impossible. You can't do it. Who are you? Why don't you just rely on the big guys like JP Morgan or Starwood? And I got the same feedback on venture. Who are you? You can't get access to the best companies, blah, blah, blah. And we did it again. I mean, our venture portfolio, I would argue, I'll argue that our portfolio of late stage private tech companies is as good as any venture portfolio in the world today, which is insane. I mean, that is insane thing to say. But if I look at the companies we own, and not all of them we have disclosed yet, but we're coming, Databricks, ServiceTitan, Canva, DBT, these companies are actually the best private tech companies in the world. The only one we don't own yet is OpenAI. But if I were to say what are the best private tech companies in the world today, we have like a lot of them, and we don't charge it. And we don't,
leaders in their categories.
Yeah, total leaders, and we don't charge a carried interest. We don't charge a 20% carried interest. So you can get into the best tech companies in the world without a carried interest. So that's very disruptive. It's so disruptive that it's actually implausible for people at the moment.
Fascinating. When it comes to your real estate portfolio, you currently have almost 300 active projects, around $7 billion in total portfolio value. Tell us more about these projects. Where are you seeing the stress, or where are the opportunities to create value?
So I have two major views about real estate investing. Sort of one is a top-down view, one's a bottom-up view.
Mm-hmm.
So on top-down, that the macro is the biggest driver of returns. And so you make 3 to 5 big decisions that drive almost all your returns. Mm-hmm. So one, we invested in the Sun Belt, not the big blue cities, since 2015. That's been a huge alpha, even though it's not that complicated. We invested in residential and industrial. We didn't invest in office and retail, right? So asset class, geography.
Yeah.
And then we focus on affordability. So we want to buy workforce housing, not, high-end luxury rental.
Mm-hmm. Yeah.
And so a handful of macro decisions, and also low leverage and things like that end up making us very resilient to a financial shock, which I went through the 2008 financial crisis. So I came away saying, well, these things they're the whole ball game. You sort of play this ball game for 8 innings, and then the 9th inning becomes like, it's like a Super Bowl like moment. It's like you have to be prepared for that. So our leverage is like 50%, 55% compared to most private real estate, which should be probably 65 to 75, maybe 80%. Mm-hmm. So anyways, that's a few macro decisions. And this is actually the same thing Blackstone says, but people don't realize it. A few thematics drive most of the returns.
Which are those?
Yeah. And they're actually very similar to Blackstone's. Because these are kind of obvious. You follow population, follow where the major growth drivers are. And then second, on the bottom up, you have like real operational people. So the people in our organization that are glorified are like ops people who are calling their property manager and be like, why did you spend, $200 replacing this light bulb and this one property? We own, we're in 20,000 apartment units and single family houses. Like they're in the weeds. They're just grinding it out. And the person who's overvalued and overglorified is the sort of like MBA analyst who's sitting with an Excel spreadsheet. Like I think they're adding not that much value. Most of the value is being added by the person who's walking that property. Yeah, in the trenches, doing like the what you'd say is really the blue collar work.
Yep, right. I think that's so spot on in terms of what really makes the difference in creating value and delivering success in real estate. You can have the right fundamentals. You can predict where the market's going to be. But at the end of the day, it gets down to the human level. Yes, we're going to streamline how we operate our buildings. We're going to add touchless access and a lot of good technology. But yeah, if we don't have the human the right human element involved, it's all going to be a waste.
Mm-hmm. Yeah. So it's and that's why we're end to end. We have like people who are world-class operators, and that's like, at the property or the tenant level. And then the other end of this, you have like software engineers writing, building mobile apps for 2 million people, right? That's mm-hmm. like, those two people in the same organization of a couple hundred people is like a unusual combination.
Yeah, no, I think, again, down to the human level now within Fundrise, I think that's spectacular. A lot to learn from there. In the heart of Silicon Valley, there's an organization making waves in helping solve the housing crisis, Housing Trust Silicon Valley. At Housing Trust, they provide developer financing, homeownership assistance, and lender and broker resources to help create more equitable and affordable communities. Established over 20 years ago by local businesses, community leaders, and affordable housing activists, Housing Trust Silicon Valley uses transformative housing finance and public and private partnerships to create a strong, affordable housing market. From those experiencing homelessness to developers, renters, and first-time home buyers, Housing Trust SV is dedicated to ensuring that every neighbor has access to safe, stable, and affordable housing. Housing Trust SV is making a difference in the 14 counties of the Greater Bay Area and Sacramento. These are communities with a common need: more affordable housing and the capital to support its development. Join the Housing Trust SV in making a lasting impact on our communities. Housing Trust Silicon Valley, where innovation meets compassion. Learn more at housingtrustsv.org. Let's move on to artificial intelligence in real estate. Now, by definition, AI is slightly overhyped, especially in, we tend to overestimate maybe what AI will be able to accomplish in the next year or two. But I think we're also underestimating what it will be like in 10 years from now. Mm-hmm. I wanted to hear from you, Ben. How are you seeing AI impact real estate, building operations? Any use cases that have caught your eye?
We have a team of people currently building product to leverage AI. We have actually two teams, one on the investor side, one on the property side. And so my thinking is consistent with what I said earlier, which is that over time, software will replace people, and that replacement will look like public markets. And so the steps in the sort of like evolution is like, first you have to get everything, all the information into a database, a structured database. Actually, maybe not even that structured anymore because AI can understand unstructured data. And a lot of real estate information is not in structured databases. So it's like we're not even to step one, right? And that's something we're working on. And then after you get an structured database, then you have to start putting, whether it's AI or other kinds of like software on top of it. But what happens is that it's going to automate or eliminate a lot of the knowledge worker activities. And so you end up, instead of needing like for a real estate company that has 10 people and most of those are analysts and kind of like people looking at Excel spreadsheets, it ends up being like 3 people and 2 of them are operations people and 1 of them basically the principal. And so you don't need an army of analysts. And the part that's going to surprise real estate people is that the real estate industry thrives on hiding data. They don't want data transparency.
Yep.
It's not what they're looking for because they thrive on taking advantage of information asymmetry.
Yep. A gated environment.
That's going to go away. As that goes away, you'll start seeing that a lot of the fees you pay are actually not justified because there's no alpha, because the information will make that obvious. And that will take time. And so the combination of like automating workflows, automating analysis, automating the data gathering, and the knowledge workers will basically start to go away because you won't need as many. And probably, this is what we're trying to do, collapse the supply chain because all these institutions that exist, this is what Tesla did. Tesla and Netflix, they both did the same thing. Whether it was like content for entertainment or it was cars, I'll do cars for a minute. The way cars used to work before Tesla is you have distribution, like so pension funds or wirehouses distribute the information, distribute the deals, right? The investments. And that's what car dealers do. Then you have, well, maybe I should flip it. Well, let me just read you this. I'll flip it to the other side. So
let's flip it.
So you start with how are cars made? Most of the parts are made by subs.
Yep.
So instead of having Ford making the car, actually like there's a window maker that makes the glass, and there's a company that makes the windshield wipers, and all the components are made by other companies. And Ford or Ford or Starwood sort of assembles it all. And there's an assembly, and then there's a distributor, which is the dealer or the wirehouse. And so there's the distributor, there's the aggregator or assembler, and then there's the producer, which is the person who builds the apartment building or builds the subcomponent of the car, like the leather seats. So what Tesla has only one company that does all of that. They collapse the entire supply chain. Same thing with Netflix, right? They distribute it online. They have algorithms that basically show you what you want. They aggregate all the content, and they actually produce it themselves too, right? And so that what technology companies often do to industry is they bundle or they integrate, and that basically allows them to reinvent it. And that's happening. It's exactly what's going to happen to all of finance in the private markets.
I think fascinating. And when you describe especially the car supply chain, I mean, you're like wow, assembling this is actually has been impressive and super hard. And now, 100 years after Toyota started, that's what's going to make them vulnerable, because it's time to collapse supply chains, because now we have the technology and we know how to do it.
Yeah.
And we also have computers.
Yeah, the problem with that model is that if you want to reinvent the car, you can't, because you don't make the car. You only assemble it.
Yeah, you just don't control
You don't control how things are made.
Yeah.
Same thing with airplanes. Airplanes are, so Boeing assembles things. It's essentially like most major companies are assemblers, and Blackstone's actually, just to pick on Blackstone for a second, they are vertically integrated. They own their suppliers, which most people don't know. Like Starwood doesn't, and neither does Carlyle, and neither does Brookfield. But Blackstone did go out and buy most of their suppliers, and suppliers are Link Logistics and Livcore and QTS, which is data centers. And so they actually realized that they had to have control over their entire value chain. And we do too. It's just we do it with software and they do it with money.
Yeah, fair. Money enables you to vertically integrate. Bringing it back to AI. So you hinted at maybe one commercial real estate asset class that is more fragile. I mean, it's already been fragile since COVID, but offices. If you're going to reduce headcount, then naturally office space will be hurt more. Do you see any commercial real estate asset classes that are more resilient or that will actually benefit from AI?
Yeah, let me do a analogy. So basically, technology has done this to real estate multiple times. So the internet launched, and e-commerce basically destroyed retail and built up industrial logistics. And so work from home or remote work is a technology. It's not obvious until you sort of think about that Zoom is basically infrastructure. And so Zoom, the remote work technology destroyed office and is building up residential, because people move from being in the office to spending time at home. And so it's driven up home values a lot. So AI basically similar dynamic where it's going to build up one part of the real estate industry and destroy another part. And so it's not clear, but it seems likely to me that it's probably building up data centers. And that's like Blackstone's ahead of the curve on that. They bought QTS. So you're going to need tons of data centers because you need tons of compute. And it's going to tear down an office more, because where you needed 10 knowledge workers, you're only going to need 5. And so you have just like e-commerce, just like work from home, these technology trends, like they're not done. E-commerce is going to continue to take more and more of the share of retail. Work from home is going to continue to innovate and drive better and better virtual reality and different kinds of technology. Makes it more likely to stay at home and not go to the office. And the same thing's going to happen with AI. And also probably these trends converge over time too, all three of them. And so the real estate industry mostly ignores the technology drivers until they can't ignore them anymore. That's what I mean by like a handful of macro trends. Geography, it's really 3 things: geography, technology, and demographics. Those 3 things are the majority of alpha in real estate, but because most people are stuck in a narrow part of the world, they spend 20 years doing office, they can't really change their resume, so they're just going to come around to different LPs saying, office is a good investment. So it's not that they don't know about these 3 things, but knowing doesn't help them.
Yep, clearly doesn't. Maybe we're going to end up having mixed use with data centers and housing together one day. Who knows?
Office, actually, we've looked at this. I think office could be replaced by data centers. We actually have an office building we're looking at. Can you replace this office building, leave the infrastructure there, but actually refill it with a data center? And that's something I think will happen as a pretty good use. Mostly data centers need fiber, like big fiber pipes, and they need electricity. And so a lot of office buildings have both those things. And so it's like a good adaptive reuse of
Now that is interesting.
Mm-hmm.
That is really interesting, because office to resi is what's taking the headlines. And personally, I would love every single empty office in downtowns to turn into housing, but just in practice, that's just not how the bricks work. And fascinating that data centers, which we all need, could be replaced could replace office. Let's shift gears now. Economic and real estate trends for 2024 and beyond. During our discovery call, you and I both agreed how, this short-termism mentality, whether it be because it's our human condition or because we have the incentives of checking quarterly earnings in the public markets or whatnot. But it really, what things play out in the next year or two, it's really, it's more important to focus longer term than that. But in current economic environment, what's your outlook on real estate in the next few years?
In downturns, let me flip that. When things are hot, like 2021, most prices or most asset classes converge and there's a lot of correlation. So the difference between a core Class A asset and a suburban asset in a tertiary market, they still end up pricing similarly. Difference between like a good tech company and a bad tech company, there's just so much convergence, because what happens is the risk premium, or another way to say it is the quality premium, goes away when there's a lot of money. When things go bad and there's not a lot of money, you see that reverse, and things start pricing very differently based on the quality of the underlying assets. You see, and then the Magnificent Seven, right? The Google and Facebook and NVIDIA doing very well, and you see a bunch of tech companies like Lemonade or a bunch of SPACs basically priced really poorly. So there's a big dispersion in downturns.
I wanted to bring up, Fundrise offers private credit, fixed income opportunities, and since the failure of multiple regional and sector-focused banks, especially the ones focused on real estate, lending, and tech, it seems like being a lender is the hottest thing out there, and that everyone and their mothers are lending in real estate. Where do you see the lending opportunities in commercial real estate penciling out in the next couple of years? Are there pockets of real estate that have more room to create value, or where incentives are more aligned between borrower and lender, or even where demand and supply of real estate sets more lenders up for success?
So I'll reframe it, because I think private credit is like a mislabeled version of what's actually happening. So I would say that most of lending for the last 75 years was public lending, because the banks are subsidized by the government. Because essentially what the banks are is guaranteed return of capital because of deposit insurance. Where does deposit insurance come from? It comes from a government guarantee. So you have this explicit government guarantee up to a certain amount, and then it turns out implicit to infinity, because even when a bank like Silicon Valley Bank goes out of business, all the money is guaranteed. And so basically banks borrow with federal guarantees and then lend to the private markets. And the problem with that model is that it's rife with conflicts of interest. And that's why banks go out of business. Lehman Brothers goes out of business, and you see all these financial crises. And so private credit is really just a lending, or is lending without government guarantees. And I can imagine a world where that's actually much better. It's more expensive, but it has less conflicts of interest and then less financial instability. And so the regulators don't like it. They call it an unregulated part of the market. But I call it it's actually an unbiased part of the market, or it's basically how lending should work. And I don't think that government should be guaranteeing deposits. And I can imagine a world where basically it goes away over time, which I think would be a very different market. But I think it's something that it's like one of those things that a lot of big changes hide in plain sight. Like something's really big and everybody takes it as like a fact that deposits should be guaranteed, for example. But it turns out it's not a fact, it's an assumption. And so, you could see a world where all of a sudden it's no longer necessary or no longer appropriate. And so over time, private credit is going to become a bigger and bigger part of the way lending works. And we're going to discover that it's actually safer and more resilient from a systemic point of view than the banks are. Because the banks are levered 93%. According to Basel III, banks levered 93%. Private credit is going to be generally levered, 2 times, rather than 9 times. And so it's just more resilient. And so I think that basically makes more sense. And that's a sort of market structure observation. In terms of tactically, there's this big mismatch between the number of borrowers that need to recapitalize, need to refinance, and the amount of money in the world. Basically the whole point of the Fed's monetary policy, which is to raise interest rates and do quantitative tightening, eliminate their balance sheet, is it just disappears money. Money is disappearing out of the economy, and that's what causes downturns. It's causing the market to slow. And basically, when there's a shortage of money, money is priced by supply and demand. And so when there's not enough supply and there's a lot of demand, you're going to get really good pricing. And so we're getting great pricing, and everybody who has money can get tremendous pricing today. And that's, whether you're in multifamily or doing it, industrial lending, whatever it is you're lending into, the environment's the opposite of 2021. In 2021, there was excess dollars, and dollars didn't get well priced. And so this goes back to my earlier comment, which is that the macro drives the majority of returns.
Interesting. I want to take this back for a second now that we have Jeff here to the innovation fund. So Jeff, in terms of the VC environment now that it's a lot harder to raise money just because of the incentives, both at the macro level, but also what is expected of companies in terms of, path to profitability, and also focus on the core business model and not trying to add a bunch of sexy potential services or products that aren't really related to the core. But what do you think the Fundrise's innovation fund enables here for companies and for the ecosystem as a whole?
I think it's another amazing entrant into what I would consider a crowded space, but crowded with groups that don't necessarily understand venture economics and real estate. So we were thrilled when we heard about what Fundrise is doing. And, hopefully we'll get to do a bunch of deals together.
Absolutely. I mean, I think
we have. I think we've done. I think at least one or two of our deals. We came into Jetty, which I'm pretty sure you're an investor in.
Nope,
not Jetty. Are you in Inspectify?
Zach,
nope.
And MetaProp.
Zach and I look alike, but we're not the same person, Ben. We're not the same person.
Despite popular belief. Yeah, I think Jetty's investor, MetaProp was an investor in Jetty.
Yeah, I mean, our advantage in venture is that we're nothing like everybody else. So there's like 5,000 or 10,000 venture funds, and they all have a different structure than us. One of my sayings I repeat a lot is ontology recapitulates phylogeny. And that means that ontogeny or ontological means it's the nature of something. If you ever studied philosophy, ontology is like a question of what's the nature of reality or being. And phylogeny is how things are structured or grow. And so how things are structured dictate how they will behave is like a way to sort of simplify what that saying means. So a fish is different than a bird, right? They're just structured differently. And so they're going to behave differently. They have gills, they have wings, whatever it is. And so we are structured radically different than a venture fund. And those radical differences over time will become more manifest. And then people like companies and investors will say, okay, I see in the ecosystem why they sort of are different and are in some cases better, in some cases worse than traditional venture fund. And being different is a huge part of being successful.
Absolutely.
And actually, I'm curious, what stages are you guys primarily acting in?
Yeah, it's so for a venture investor, I would tell them we're a growth equity fund. But most of the public never heard of a growth equity fund, so they don't know what that means. So I just say venture fund. So our portfolio here, I'll give you some sort of approximate stats on our portfolio. So the average or sort of weighted average revenue of our portfolio companies is, I think, about $1 billion. And the growth rate is 73% a year. And so that is
Wait, hold on. I want to repeat that. a billion in ARR?
Yes.
And the average?
The weighted average, yeah. Because basically, this is, the companies we invested in, the majority of the fund are in Databricks, ServiceTitan, Canva. These companies, I'll go on the list, but these companies have huge revenues, huge growth, are private still. And that's a very, very, very different animal than our tech. We invested in a couple smaller kind of early to mid-stage prop tech companies who have ones or tens of millions of dollars in revenue. So it's so radically different from what you do.
Yeah, well, because I was going to say, I'm familiar with Jetty, and I don't think they're
right. No, I mean, those two companies, Spectify and Jetty, are only, I think, 5% of our portfolio. And the vast majority of the portfolio, like 70-80% of it is companies that are late stage, pre-IPO, and have huge revenues and huge growth. like to have 73% annual growth rate at
It's unbelievable.
at like hundreds of millions or billions of revenue it's what I was arguing. I was saying this earlier, basically, that like we were lucky. We launched the fund last year, so we had really good vintage, and so we could go out and cherry pick the best later stage companies, and that basically was like mostly luck, a little bit of execution, because we actually we actually started the fund, we launched the fund, sat on the fundraising. We didn't really deploy it very quickly because we were waiting for the market to sort of like ripen. That was like, it was hard because investors were like, I don't understand why you have $32 million in cash. I was like, just wait a second. Not yet. So yeah, it's a different animal. We're so different. We're evergreen fund. We don't have, so it's a perpetual life fund, which is super different. So when they go public, I think Databricks will go public. We're not a seller, right? There's no reason to sell. And we don't charge a carried interest. So no 20% carried interest, which is also, radically different. Yeah.
That's amazing. Amazing.
Yeah, we're lucky. We're lucky because we basically can do, I think it would be hard for a venture fund to do what we did because their LPs didn't hire them to do the job that like we ended up doing. Because when we launched the fund, we thought we'd do one thing, and then the market changed so much. Like so the opportunity went from, like Jeff knows this, but like if you were trying to invest into great mid to late stage companies in 2022 and let's say 2023, so over the last 12 months, the best mid to late stage companies were not raising money because they said, why would I raise money in this environment?
Or they already had plenty because they had taken advantage of the environment in 2020, 2021.
Right. So basically the best companies, and venture capital is about investing in the best companies because there's this power law. So the best companies weren't raising. And so we were sitting there saying, well, how do we invest this fund when the best companies don't raise money? And there were some little exceptions. We made a few small ones. We invested in Vanta, which is a really good company, but it was a $5 million investment. And then what we discovered was you could get into the best companies by buying from funds that were motivated sellers. So we bought into some of these companies from motivated sellers at good prices. And that was not how we originally thought we'd deploy. But we ended up getting into, I really think these are just the best companies like you could invest in. And we got to them in a non-traditional way. That's not how normal venture funds invest. So in order to invest in secondaries, you need a couple of things, but one of them is you have to be a registered investment advisor. And that means you're regulated. Most venture funds are exempt from being a regulated entity, but we are highly regulated. We are a registered investment advisor. And so we could and did invest in secondaries. In the majority of the fund, we basically ended up investing in secondaries because that was where the opportunity was in 2022 and 2023.
I mean, I see here a combination of being in the right place at the right time, but also goes back to timing. And you said this earlier when you were talking about your real estate strategy, investing in housing and investing in industrial back in 2015 before it was that trendy. And now with venture, right, at a time where you could get extremely good pricing, where funding had evaporated and where companies were afraid of getting down rounds, but you were there to strategically deploy and grow this innovation fund.
Yeah, and I just to recapitulate a couple of my points or reiterate, we had a structure that let us be flexible, and most fund managers, most sponsors just don't have that flexibility. They can't be a real estate investor in multifamily and switch to industrial. They can't be investing in New York and switch to Orlando. They can't be investing in Series Bs and switch to secondaries and Series D. It's just not how they're designed. However, the market is moving so fast. There was a hot market, and then there was a pandemic, and then there was a really hot market, and then there was a interest rate spike, and the market collapsed again, and that happened in 36 months. And so the necessity of flexibility has become more paramount than ever.
Yeah.
But the financial industry is not designed for flexibility. So much of our ability to be successful is because of the way we're structured. Most people in our seat are smarter and know exactly what we know, but they can't do it. They're not allowed to.
So as a long-time Fundrise shareholder, what Can you tell us, like, for the original folks that invest in Fundrise corporate, what would you say to us, like, when we're thinking about an exit path from Fundrise corporate? How should we think about that as an early investor?
Yeah, so Camber Creek, it was a Series A investor. It took longer for us to get to scale because we had to evolve the business to find product market fit, which I believe we have. And our path, or at least our goal, is to go public. I think it's, our revenue is about $65 million this year. And so we're a few years from being able to go public, but I believe we will have the metrics to hit a public offering and be well received. And just for those who aren't familiar with public markets, typically you need 100 million in revenue. You need to be growing at a good rate, which is probably 20 to 40%. You need to be profitable, path to profitable, or if you're really profitable, then you're really well liked. And I think we can hit all those goals. And a lot of the timing will depend on when the environment sort of becomes more favorable. We're in a recession. We're in a real estate recession. Most of the tech industry is actually in a recession. And it's just going to take a while before I think the market turns around. And I think that's probably late 2025. So I believe we executed. It just took longer. Unfortunately, it took longer than I originally hoped.
I like that answer.
I think in retrospect now, probably the path made a lot of sense. But when you're back there looking forward, you're like, this pivot or adjusting to market to become more flexible, right? I think looking back, probably those steps now make a lot of sense, but it's encouraging for all entrepreneurs out there to know that even though the future may look a bit nebulous at times, if you just keep focused on the mission, keep focused and listen to the customers and to the macro, especially if you're in real estate, you'll come out on the positive side at the end.
Yeah, let me just say one kind of major lesson I learned. Mm-hmm. Every big, major, long-term decision we made that was right in the long term, we were punished for in the short run. Boom. And so your willingness
Can you give an example? Because I think that's a really important point.
I can give you two examples. So one is we used to allow investors to invest deal by deal. We moved to a diversified fund model, and we lost half our customers in that transition in 2016. Half our customers were like, no, I want to be picking this deal or that deal. And I thought that was not going to be a scalable, resilient model. And half our customers were pissed. And you look back and you say flexibility, you have no flexibility if you're deal by deal. So that's an example. And then recently we launched, we diversified from being just real estate to doing credit and tech. And a ton of our investors are like, I don't understand why you're going to multiple asset classes. Why are you investing in tech? That's not what we hired you to do. We hired you to do a job, and we're pissed that you're basically doing more than that job. You're basically driving to multiple asset classes. And I know, because I'm in the trenches, that is way better for our investors and way better for the company, because sometimes the best investment is not real estate. Sometimes it's credit, or sometimes it's tech. And that flexibility is going to drive good outcomes for everybody. But people at the first basically didn't trust us to do the job.
I think that's fascinating, especially because basically if you're getting punished in the short term for something, take it with a grain of salt, and you're probably doing the right thing if you're staying true to your mission and to your customers.
Yeah, it's transparency is another good example that people don't like transparency in the short run because you get punished for it. Because the reason you get punished is in the beginning when you're transparent about, let's say, something that's like there's some drama and you're transparent about it. People don't know what to believe, and they don't believe you at first. So you get punished. Because generally the reason you're getting punished is people don't believe that you're right. But if you are right in the long term, you win.
The human condition of cognitive dissonance, or of just, sometimes we're not used to that, maybe radical transparency or radical, like directness, if you will.
Well, it only works if you're right.
Right. Right. As long as you're sharing, what's in front of you with the current, with the current information that that's all you can do, right? Ben, collaboration superpower. If you could choose one person, historic or living, to do a collaboration with, to do a partnership with, who would it be?
So the way I think about trying to do things that are worthwhile, and for me, is I try to find problems that I think are significant. And then, so if you tackle a big problem, then you end up having a lot of impact. So if I were to leave business, one of the biggest problems in our society today is essentially we in our country no longer attract political leadership that is high quality. And I don't want to be a political leader for exactly the same reason most people wouldn't. You just get punished. You get destroyed. So that's a problem, because if we don't have great leadership, then we're not going to end up having a great country, because it's just going to compound over time. And so that's a problem that I'd like to attack. And you say, well, who could help you do that? Like and so the best I could think of is Hamilton. If Hamilton came back to life and basically he was, this is what he was world class at. And you basically said, okay, like, let's gather up people who care about this thing. How would you attack it? How would you try to create a model where people, great selfless leadership would end up in places of power in America? Like that's a problem that we need to address as a cultural and social problem. But Absolutely. It's one that we have. I mean, if our generation doesn't do it, then the next generation has to do it. But if we don't do that, God, it's good luck to us.
I love that. Alexander Hamilton, founding father of the U.S. and first Secretary of Treasury. Mm-hmm. I think the big issue with the public sector, starting with the fact that it's hard for them to compete with the private sector on an economic incentive basis. Also, the nature of public office now is you do spend a lot or most of your time either doing fundraising or doing just public-facing work and not doing the actual work. And I think that tends to attract certain type of people that maybe are less focused or less motivated by having a positive impact on society and more on just being out there. And, yes, they have to take the punches, but also they do it for their own personal motivations. And I think that's an issue. Ben Miller, where can listeners learn more about Fundrise and connect with you?
Well, I'm active on Twitter at Ben Millerize and fundrise.com.
Ben is also a fellow podcast host at Onward, Fundrise's podcast, so make sure to check it out.
Thanks for having me.
Thank you so much for coming to Tangent today. If you like what you heard, please subscribe, rate, and review Tangent and share the show with a friend. This episode is produced by me, Edward Cohen. Thanks for listening to Tangent, and remember, collaboration is our superpower. So stay curious and always be learning.